to discuss the Secure Act 2.0. So let's get right into it and kind of start with that. So let's jump in, get to the next slide here. Disclosure: past performance doesn't guarantee a future performance. I am not your tax or your legal counsel or your general counsel. All advice is specific to you. So that's always good to have out there. Let's go to the next part. So let's talk about what we're going to talk about today. We're going to talk about what is Secure Act 2.0, expansions of automatic enrollment, the starter 401k plan, right? Catch-up contribution limits, startup credit increased, long-term part-time employees, student loan repayments can be treated as deferrals for participating in matches. What is the savers match? Required minimum distribution age increase. And then let's talk about the matching and non-elective contributions that may be treated as Roth contributions and any other provisions that are out there. So let's hop right into it, have a little fun. Start with this. The Secure Act 2.0 is a part of the spending bill released in December 19, recently signed into law. So this is hot and fresh and right off the presses. So we are excited to be your resource to start here. So when you think about the Secure 2.0, what are the most important pieces that we're talking about here, right? Let's talk about the expansion of automatic enrollment. So after December 31st of 2024, employees will be automatically enrolled at 3%, from 1% up to 10% cap. Small business with 10 or fewer employees, churches, government employers, and employers that have been in business for less than 3 years are excluded from this provision, though. And the key to automatic enrollment is really important. You know, the old adage, if you don't see it, you don't miss it, right? So the idea behind it is you're going to go ahead and start investing the money into your 401k, 3%, right when you join an employer, and you don't even have to worry about it. It comes out of your check, and if you don't see it, you don't miss it, right? It escalates up to 1% each year and getting you cent cap. We have a retirement problem right now in the world in general, right? People aren't saving enough for retirement, aren't setting aside enough for retirement, for whatever reason that is. So this is designed to help you increase your retirement savings. So let's talk about this next piece here, the starter 401k plans, right? So for employers who don't sponsor a 401k plan, right, they can do what they call a starter K plan. And a starter K plan really is simple, straight up. And what it is, it's a new simplified safe 401k plan. And safe harbor just means that there's no testing and discrimination. And what that means to you as the employee is that, you don't have to worry about a plan, having issues or sending back money or whatever that is, right? In terms of them not meeting their testing limits and all that good stuff. Intended to make it easier for small businesses to start a 401k. Annual contribution limits are limited to $1,000. Okay, so that's really what a starter 401k plan is. Now, let's get to this next piece here, right? When we talk about, and again, these deferrals are affecting years. I want to move my head up here. Let's see. No, don't do that. No. Okay, there we go. All right. So let's talk about the catch-up contribution limits that are effective. Again, like I said, the contribution limits are $6,000. Catch-up contributions are additional $1,000 if limited. And deferral are effective for plans years after December 31st, 2023. Catch-up contribution limits. This is a big change, effective for plan years after December 31st, 2023. Catch-up contributions can be made, must be made as Roth contributions for any participants who earn more than $145,000 as indexed. This is important because in the past you were able to do catch-up contributions, and let's say the contribution limit was $22,000, you do another maybe $6,000, right? Well, they basically have figured out that they don't want high-income earners to defer more in taxes. Um, so they're going to basically force those catch-up contributions to be Roth, right? Isn't always a bad thing, to be frank. The Roth portion of it is going to be tax deferred and potentially grow tax free if taken out properly. The participants between ages 60 and 63, the catch-up contribution limit has increased to the greater of $10,000 or 50% more than the regular catch-up amounts, right? These amounts will be indexed for inflation after 2025, and provisions are effective for tax years of December 31st, 2024. Okay, startup credits. This is important for the business owners, but it may be important for you as the employee. So when you're the employee and you're looking at a 401k plan, you're thinking to yourself, gosh, I wish I could get a 401k plan. How can I get my small business owner employer to consider doing a 401k? First thing, the credit has increased from 50% of the admin costs up to 100% of the admin costs, up to a max of $5,000 for those that have 50 or fewer employees, with also $1,000 in cap per employee for the match. The credit phases out with employees for more than 51 employees, and this plan is effective for years after December 31st, 2022. So this year, literally right now, if your employer wants to start up a 401k, he could get a tax credit for the cost. He or she could get a tax credit for the cost that's involved in setting up a 401k, and also the cost involved in matching for the employee up to a maximum of $1,000, right? So that's generally actually a pretty attractive tax credit for employers to consider. So the next thing is the startup credits also may also apply to employees joining a multiple employer plan or a pooled employer plan, regardless of how long the pooled employer plan or multiple employer plan has been in place. All good news here. So let's talk about the long-term employees, long-term part-time employees, right? Part-time employees are eligible to participate in the plan if they've completed 500 hours of service within 2 years. This is effective for the plans after 2024. This is a change from the original Secure Act, which required 3 consecutive years. In addition, the vesting service is only counted from 2021 forward, where an employee has worked 500 hours. This does not apply to bargain plans, right? Collective bargaining plans, right? So it's important now that if you have people who have worked in part-time jobs, part-time opportunities for multiple years, and always have been told that they cannot be a part of the 401k, this now basically makes them a part of the 401k, which is a great opportunity. Plus, now you're eligible for the match as well, right? So that's a good idea. Okay, let's talk about the student loans and student loan payments that can be treated as deferrals, right? So the most important thing is this is an optional provision, and basically testing can be done separately for those who receive it. So the idea behind it is the student loan payments can be treated as the deferrals for the participants receiving a matching contribution, right? So there's a really cool feature in there built on to help students who graduate college with a lot of debts, that are making that choice between paying down debts or deferring for their 401k in their future retirement. Savers Match. Currently, there's a credit for employees who make a contribution to their plan based on their income. The credit is being changed to a tax refund as a federal matching contribution that must be paid into the taxpayer's IRA or retirement plan. So the match of contributions up to $2,000 per individual, which is pretty significant, right? The match phases out between $25,000 and $35,000 for single file tax returns. But if you're Another who maybe has, um, limited income, or your child who's starting to save money for retirement, who has limited income. This is a great opportunity for them to get a $2,000 contribution, 50% of the up to $2,000, right? So if they're filing jointly, the amount phases out between 41,000 and 71,000. This is effective after 2026, and the provision also directs that the Treasury Department has increased public awareness of the savers match. Okay, required minimum distributions. This is a good one. It's very important for us to consider the required minimum distributions that are out there. So the next thing you think about the required minimum distributions is, what is the change right now, right? So the change right now in the required minimum distributions is that the Secure 2.0 increases the age to 73 starting January 1st of 2023, and then 75 into 2033. So it's important for you to know one important thing that the government is kind of hinting at there. You better start saving for yourself, because they are thinking about pushing things further and further out for people, right? So the employer matching and non-elective contributions may be treated as Roth contributions, right? Meaning this is optional, permitted 401k, 403bs, and effective immediately, right? Employer matching and non-elective contributions may be treated as Roth contributions. In the past, this was not so. You had to only put it for pre-tax dollars, right? So it's really important that if you want to, you can get your matches in Roth, which I think is great. Some other provisions that are out there. Okay, expansion of the employee plan compliance resolution system for self-correction, right? Mandatory force-out limits increase from 5,000 to 7,000, right? And there is an $1,000 emergency distribution that can be repaid within 3 years, not subject to the 10% penalty, right? This is important for the folks that really rely on the 401k as their emergency fund. Other provisions, right? An optional emergency savings account up to $2,500 for non-highly compensated employees. Contributions are treated as Roth deferrals. Eligible for matching contributions. Distributions are treated as qualified distributions, so earnings are non-taxable. The first 4 withdrawals from each plan may be subject to fees, and the employees may roll this into their 401k at a new employer or IRA if they terminate employment, right? The other part is for the teachers and the government employees out here. This is probably the biggest piece out there. 403b plans may offer collective investment trust effective immediately, right? No longer are you stuck to that kind of single individual account type stuff that you have out there. Overpayments do not have to be recouped from retirees, so that's important. Now, let's get to some other important provisions, right? Effective immediately, the penalty for failing to take a required minimum distribution is reduced from 50 to 25%. If the failure is corrected in a timely manner, the excise tax can be reduced by 10%. Effective immediately, participating 457 plans may request deferral rate changes. Qualified birth or adoption plans can be repaid within 3 years without 10% penalty. So all these are important, and employees may certify a hardship event reason effective immediately. So as we're going through this, one of the things that isn't on these slides is that the government also recently, in regards to this plan, put together a kind of a retirement savings lost and found, created a repository for employee benefits, an account, and using data that employers already report to the Treasury. So it kind of alleviates that difficulty in recovering missing in savings due to a job change, company merger, name changes, etc., right? So you can kind of help find your assets that are out there that maybe are jobs that you worked here and there, right? So the family attribution rules um, are removed from spouses with separate unrelated businesses, right? Starting in 2023, amendments that result in an increase in benefit from previous plan year are permitted by until the employer tax return date is due. For effective for plan years beginning after 2022, notices are eliminated for participants who are not participating. So also very important for you to not really stay on top of your 401k and your 401k savings, right? You see here again, notices are eliminated for years, right? And the Treasury is going to create standardized sample forms for direct rollovers and trustee transfers by January 2025, just to make that process of rolling over funds a little bit easier, right? Because right now the forms are very cumbersome. The employees will terminate with terminal illness. Will not be subject to a 10% penalty. Employers can replace simple 401k plans with safe harbor plans anytime during the year after December 31st of 2023. Group of plans. Only individual plans within the audit that are subject to the audit are required to have an annual audit. This is not required of all the plans, including the 5,500, right? So this just kind of alleviates some pressure for the employers in their audit expense. This also allows them to transition to different plans more nimbly, right? And like 401k, hardship withdrawals will be available from all sources in 403B plans. I'm sorry, my face is cutting off this number, but it's 403B plans. So in the past, 403B plans were not as uniform as the 401k plans in terms of their ability to have hardship withdrawals. So this is a big opportunity for people to kind of look at and go, okay, what can I do differently? That kind of stuff. Okay. Any questions from the audience? So let's see if there's anything out there. Okay, going once, going twice. So I'll add in a couple of nuggets in here. Starting in 2024, participants may withdraw the lesser of $10,000 or 50% of their accounts, and in case of domestic abuse, free from 10% penalty, right? It's intended to provide emergency funding for victims of domestic abuse, right? So that's one thing that's added in there. Let's see, what else is out there? I think those are the big ones. Oh, there is one more. Retirement income, right? So a lot of times people go, okay, I've got retirement assets, but then I want retirement income, right? And they repealed the 25% contribution limit from the qualified account balance into the qualified longevity annuity contract. Contribution limits would be raised to $200,000. So qualified longevity annuity contracts are designed to reduce longevity risk and for participants who are less likely to outlive their assets, right? The other part is that the IRS has allowed 403B plans to use collective investment trusts. I think we talked about this, and join pooled employer plans and multi-employer plans. However, the bill lacks certain, federal securities laws to facilitate collective investment trust inclusion to a 403B plan, right? The provision brings kind of 403B plans to the 401k plans. Collective investment trusts usually offer lower fees, potentially creating cost savings for participants and sponsors. And once they become practically available, failing to consider a collective investment trust could increase the litigation risk for a 403B plan, right? Plan sponsor, right? So it's almost kind of pushing the 403B plan closer to resembling like a 401k, which is great for the teachers in the world that do so much for us, nonprofit workers, government employees that do so much for us, that have a 403B plan that some people consider not as modern I'll say that, as the current 401k business, right? So that is our Secure Act 2.0 webinar. We appreciate you taking time to watch us and thank you, and give us a call if you need anything, or message us or email us or anything like that.